Peter L. Bernstein, Capital Ideas, The Improbable Origins of Modern Wall Street. Embark on a journey through the remarkable transformation of the U.S. capital markets in Peter L. Bernstein's book, Capital Ideas, The Improbable Origins of Modern Wall Street. In this summary, we will explore how the 1974 stock market decline paved the way for groundbreaking ideas and tools that shaped modern financial markets, inspired by academics who studied risk management and investment applications. Witness the establishment of efficient stock portfolios and the development of the capital asset pricing model, as well as the exploration of stock price predictability and the role of information in determining value. Get ready to delve into the origins of modern Wall Street and the evolution of financial theories that redefine the market as we know it.
The birth of modern U.S. capital markets. In the aftermath of the 1974 market crash and economic downturn caused by inflation, traditional investment professionals turned to academia for new strategies. Scholars studying finance had developed complex risk management concepts that could be adapted to investment practices. Initially, these ideas were dismissed as impractical, but major Wall Street firms began to implement them. The transformation of the U.S. capital markets began with these revolutionary ideas. By taking risks and investing in new ventures, investment firms transformed the market and created modern capital markets. Markowitz and the birth of modern portfolio theory. In the 1950s, the idea of studying the stock market was unpopular in business schools. However, it caught the attention of University of Chicago student, Harry Markowitz. Through his research, Markowitz introduced the idea of treating stocks as a collection of assets held in a portfolio. He proposed that investors choose diversified stocks with varying price activity to build efficient portfolios that produce the highest anticipated return within a parallel risk level. Through his groundbreaking work, he linked risk to the covariance of an entire portfolio, not its individual holdings, which earned him the Nobel Prize in 1990. His work marks the birth of modern portfolio theory and remains influential today. The power of portfolio diversification. This book extract discusses the groundbreaking work of Markowitz, Tobin, and Keynes in the field of portfolio diversification. Markowitz's theories on diversification and mathematical models were simplified by Tobin, who proposed that investors should build portfolios from a mix of both risky and less risky assets. Tobin's separation theorem suggested that investors should follow a two-step process in selecting their portfolios, and could reduce risk by investing in treasury bonds or using leverage to invest in riskier assets. Keynes' concept of liquidity preference also played a significant role in these theories. Through their combined ideas, investors can build efficient portfolios with risk levels that align with their personal comfort, enhancing the average level of risk-taking in society. The stock market makes diversification easy and inexpensive, making it an essential tool for investors. The evolution of modern portfolio theory. This summary explores the early beginnings of modern portfolio theory and how it evolved over time. It delves into the contributions of notable statisticians, astrophysicists, and economists in understanding market pricing and determining stock values. Bill Sharp's simplified approach of determining the covariance of securities and his concept of an underlying factor that affects portfolio returns is discussed. This then led to the creation of the capital asset pricing model, for which Sharp won the Nobel Prize in 1990. The summary also touches on the role of information and noise in determining stock prices, as well as the variation between a stock's price and its value. Eugene Fama's contribution to understanding stock prices. Eugene Fama, a Tufts University undergraduate who earned a Ph.D. in finance from the University of Chicago, made a significant contribution to the understanding of stock prices. In his research, Fama discovered that stock prices were unpredictable, using the term random walk to define his findings. As a professor at the University of Chicago, Fama introduced the work of Markowitz to his students and collaborated with his colleagues to conduct a large-scale data collection project on stock prices, which showed that stocks provided superior returns compared to other investment options. This research generated widespread interest among academics and the investing public, proving instrumental in transforming the investment landscape. Fama also criticized the investment management industry for making money from client fees rather than personal investments, aligning with economist Paul Samuelson's belief that getting rich from investing was difficult. Corporate valuation pioneers. Two scholars, Merton Miller and Franco Modigliani, approached the problem of finding the best mix of securities to make a corporation more valuable to shareholders. In their quest, they investigated the cost of capital for corporate activities, including spending on new assets. They found that corporations had no guidelines in this area. Their work advanced the case for corporate valuation and arbitrage pricing. Moreover, all of this had major macroeconomic implications. The duo won Nobel Prizes for their work on addressing the optimal corporate finance structure. John Burr Williams, on the other hand, tried to address the problem of how to buy a security at the best price. He pinpointed a stock's future dividend stream as a main factor in helping determine its price and attractiveness, transforming into the dividend discount model.
In conclusion, Capital Ideas by Peter L. Bernstein unveils a fascinating account of how groundbreaking academic theories and models revolutionized the financial landscape on Wall Street after the 1974 stock market decline. It illustrates the intersection of academia and real-world investment strategies, showcasing the contributions of luminaries such as Harry Markowitz, James Tobin, Paul Samuelson, Eugene Fama, and Merton Miller. Their insights led to portfolio diversification, risk management, capital asset pricing, and the introduction of the random walk in stock prices. The innovative ideas of these trailblazers became essential in constructing the foundation upon which modern Wall Street was built, and their influence remains deeply ingrained in today's financial markets.